We're going to focus on how the government funds a budget deficit in this video. So we know that a budget deficit is when government revenue is less than government expenses. And this usually occurs in times of economic downturn. So when the government tries to stimulate the economy, they're going to use expansionary budgetary policy, which also is a budget deficit. So this is expansionary budgetary policy. Okay. So we're going to look at how the government actually funds for the budget deficit, given that they don't have enough revenue to fund for all their expenses. So there are three major ways, or main ways, that the government can finance a budget deficit. We're going to go through all three of them systematically. So firstly, we have overseas borrowing. To make overseas a little bit clearer, sorry guys. Overseas borrowing. That's the first option the government can take. So what this means is that they can offer to sell government securities. Because investors overseas want to invest and gain a rate of return, they could offer government securities to sell in return for money. And the funds that they generate from selling these securities, they can then use to fund for the government budget deficit. However, the consequence of borrowing overseas is that it adds to our NFD. And the reason it adds to our NFD is that interest repayments on securities increases the current account deficit. So take, for example, the government issues $100 million bonds. So this basically says, I'm going to pay you $100 million in, say, 20 years at a rate of 5% per annum. So the 5% per annum there, so the interest of 5% per annum is going to be recorded in the current account. And it's going to be recorded in the primary incomes category of the current account. So overseas borrowing can fund for government expenses, but it causes the CAD to increase, and then by extension, because the CAD is the deficit accumulated in one financial year, this is going to accumulate to the net foreign debt, or the total foreign debt owed by the government to non-residents of Australia. So that's one way of funding the budget deficit, is to borrow overseas. Secondly, they could borrow from the RBA. So we know that the RBA, or the Reserve Bank of Australia, is a separate entity to the government. So what the government could do is they could firstly take from their savings accumulated through times of budget surplus, accumulated by surpluses. That could be one option, or they could take another option of, again, selling government bonds to the RBA. So when they sell government bonds to the RBA, it essentially asks the RBA to print more money. And this is a very expansionary measure the government is going to take. And this is, must note, in red, very expansionary. In most cases, the government would not tend to do this because of the very high consequences on inflation and our purchasing power. So it directly adds to the volume of money and spending in circulation. And as we know, as the supply of money increases, therefore the Australian dollar will depreciate, and also inflation would increase. So that would have a very, very high impact on the achievement of other government goals. So borrowing from the RBA, especially by selling government bonds so that the RBA can print more money, is a very expansionary strategy the government would take, and is very rarely used. So lastly, we can see that the RBA can borrow from the private sector. And again, the private sector in this case means the Australian public, or it means financial institutions in Australia. So what they could do is they could again sell treasury bonds and securities. So essentially these are IOUs to the Australian public, saying, okay, if we can borrow, say, $100 million, now we will pay you back the $100 million plus interest in a year's time. And in most cases, the Australian public or the financial sector will allow the government to borrow from them because of the low risk involved from lending to the government. So there is a very low default risk by the government because of the ability that the government can print money willingly if they want to get out of debt. And although that may be a very expansionary measure to get out of debt, and it could be at the detriment of the economy, we can see that the financial sector have very low risk in lending to the government as opposed to other credit rating or low credit rated companies. So we can see that they can borrow from the private sector, but the consequence of borrowing from the private sector is this idea of crowding out. And the crowding out effect means that they will push up interest rates or compete with the private sector for funds, and therefore push up interest rates and therefore discourage spending, which is actually contradictory to the effect or the intended effect of the budget deficit. So there are three types of funding the government can use to fund a budget deficit. 1, overseas borrowing. 2, borrow from the RBA. Or 3, borrow from the private and financial sectors.